Understanding capital budgeting for the CMA exam. Introduction. Capital budgeting is one of the most critical concepts in managerial accounting and finance. It helps businesses decide where to invest their money for long-term growth. As a CMA exam taker, you'll need to understand key techniques like net present value (NPV), internal rate of return (IRR), payback period, and profitability index, not just their formulas, but how to apply them in decision-making. 1. What is capital budgeting? Capital budgeting is the process of evaluating investment projects to determine which ones will maximize a company's value. These investments are long-term and involve significant costs, such as buying new equipment, expanding a production facility, launching a new product line. Since these investments impact the company for years, accurate decision-making is essential. 2. Key capital budgeting techniques. Net present value (NPV). Formula. Net present value equals sum of cash flow (NT) divided by 1 plus R to the power (FT) minus initial investment, where R means discount rate or cost of capital. T means year of cash flow. Decision rule. If net present value greater than 0, accept the project. If net present value less than 0, then reject the project. Example, a company invests $500,000 in equipment that generates $150,000 annually for 5 years. If the discount rate is 10%, calculating NPV determines if it's a good investment. B. Internal rate of return (IRR). IRR is the discount rate at which NPV equals 0. Decision rule. If IRR greater than cost of capital, accept the project. If IRR less than cost of capital, reject it. Example, if a project has an IRR of 14%, but the company's cost of capital is 10%, the project is profitable. C. Payback period. This tells us how quickly an investment recovers its initial cost. Formula. Payback period equal initial investment divided by annual cash inflow. Example, a $300,000 investment that generates $75,000 per year has a payback period of 4 years. D. Profitability index (PI). PI helps compare projects when capital is limited. Formula. PI equals present value of future cash flow over initial investment. Decision rule. If PI greater than 1, accept the project. If PI less than 1, reject project. Example, if PI equals 1.3, it means that for every $1 invested, the project generates $1.30 in value. 3. Step-by-step case study. Imagine a company is choosing between 2 projects. Compare projects in the table, A versus B, and make a decision which project would be the better choice. Here you may pause the video and take time to think. Decision. Project A has a higher NPV and IRR, so it's the better choice. 4. Common mistakes in capital budgeting. Ignoring risk. Always adjust discount rates for riskier projects. Relying only on payback period. It doesn't consider the full financial picture. Not considering opportunity cost. Investing in one project means missing out on another.